Welcome to Stock Cheat Sheets, where we trend, rank, and grade stocks and exchange traded funds. Our data helps forecast which parts of the market are about to get hot and which equities are likely to blow up in your face. You can subscribe and get cheat sheets delivered to your inbox. Best of all, it's free. Go to stockcheatsheets.substack.com to learn more.
Now, here's today's free update.
I'm actually calling this the Unfair Advantage Investing Podcast. I'm Mike O'Connor, author of Cheat Sheets, and I'm joined usually once a week by Aaron Montel, AA.
Hey, Mike.
He's passed some, but not all of the chartered market technician criteria. So he's our technical analyst.
I call
and he
myself.
also he runs a really interesting mortgage company. It's Local Advantage Mortgage, that's I believe the name of it.
Yeah, that's right.
And you got a Substack. And
Macro to mortgage.
Yep, macro to mortgage. And the whole game there is, and this is especially important right now because let's face it, home prices are still kind of high, and interest rates are not cheap. And so you basically look at the bond market and associated macro indicators, and what's different about you for your clients is that you're basically gaming out where the 10-year Treasury note yield is going to be. Maybe just explain really quick why that's important. That'll dovetail us into a conversation about the market.
Yeah, so in the mortgage space, the 10 year is kind of the benchmark, as its duration is most closely related to, the typical lifespan of a mortgage. I know that, the average mortgage is a 30-year fixed loan, but in reality, that loan only lasts 7 to 10 years. So before it's refinanced or sold or whatever the case may be. So the 10 years is kind of the benchmark to gauge direction of mortgage rates.
Yep. And so mortgage rates kind of flat right now. And I think we're going to talk about the Fed and the economic news of the week to start. Sorry about my screen from hell. And you'll have to tell me kind of what the layout looks like. I want to make sure I get this layout right. Whoops, I got to get back to StreamYard. Sorry about this. I think what we want to do is take our mugs off the screen with the expanded screen from hell. And now you should be able to see my screen fully with the blog update from over the weekend.
That's right. What's moving markets?
So obviously economic data, probably not as important last week, although we had another inflationary, what was it? The CME earlier. There was one inflation metric, I think on Monday, but prior to that, we had a whole slew of inflationary indicators leading up to the Fed meeting. And then, of course, the Fed meeting itself took place on Wednesday.
That's right.
And so we really didn't find any signs of, well, it's kind of weird. Obviously all the inflation measures are basically, what do you call it? Not leading indicators, but the opposite, following indicators.
Trailing.
Yeah, good word. But the leading indicators actually suggesting the economy is soft or getting soft. We're starting to see unemployment tick up. And I think we actually had kind of a softer jobs report on Friday. I didn't actually look at the numbers.
It was on the headline. It was softer. It was much softer, quote unquote, softer than expectations.
Yep.
But on a 3-month basis, the 3-month average is still something like 240,000. So,
yep.
So on the surface, it might appear soft, but it was still okay.
And you and I, so we've got kind of some crosswinds going on in the economy. We've got, listen, there's just more people retiring now than there are bodies to replace those retirees. So we're going to be stuck with wage inflation in perpetuity. And the fact that the globe is sort of unwinding in terms of its interconnectedness means that the industrial production pressure and the need to build out infrastructure is going to be much higher in the years to come. So I don't think either one of us are under any kind of illusion that the Fed is going to be able to just flip an interest rate switch and solve the inflation problem. We're going to have a resource inflation problem and a wage inflation problem for at least the next decade.
Things have structurally changed.
Yep. And so when you add that to the fact that debt is really high and the Fed really should probably be raising interest rates now into these inflationary numbers, but it can't because then the cost of government debt becomes unsustainable. The middle class has basically got their credit cards on max. I saw some very disturbing statistic that people over 50, about 70% of them can't even afford $1,000 emergency medical expense right now.
Yeah, I mean, it's definitely hard times for a large swath of the population.
So you have the consumer maxed out. You have the wage inflation and resource inflation not going anywhere. But at the same time, a little bit of softness in the jobs market. Maybe we're just barely seeing it, and it's mostly anecdotal when Elon Musk snaps his fingers and lays off 15,000 Tesla workers. You got to pay attention to that because it's not like battery-driven automotive technology is a rear-view mirror technology. That should be where the jobs are coming from.
Yeah, I will push back on that just a little bit and say, Elon Musk, he may snap his fingers and lay off 15,000 tech employees, but do those tech employees remain unemployed long enough to even file for unemployment, or are they getting snapped up somewhere else?
I don't know. It's all anecdotal for the most part, and the jobs numbers are definitely not showing that stress in the economy. But I would say it would be fair to come to the conclusion that the Fed is in a bit of a rocket at a hard place. It certainly can't cut right now. And I think the idea of raising interest rates, that would really topple things over. And they're not going to do that during election year.
Yeah, I agree with that statement completely.
So then we have kind of a market performance that's been meh lately, a little bit. We're not, it doesn't look like we're nearly as bearish as maybe we were a week ago, whether this is just a short-term relief from the idea of the Fed not having taken more rate cuts off the table. Maybe the market recovered that. And let's face it, now with about 80% or more of the S&P 500 reporting earnings, and most of them beating, we don't yet see that corporate profit shrinkage impacting prices yet. But it just feels like a ticking time bomb to me.
Yeah, but it's felt that way to me for some time, and it hasn't to be.
Yep. Well, and the thing is, markets, when they're in, when they're on a momentous course, they can stay in momentum a lot longer than the economic reality would dictate. I would argue the same thing is true that when we do finally hit that tipping point, and let's face it, we are off our highs. We don't know if we've had that tipping point yet, but things could go down for quite a while once they start going down.
Right. As they say, things happen slowly and then all at once.
Yep. So what we're going to do today, and by the way, you can subscribe to stockcheatsheets.substack.com. I put out a blog for free at least 3 times a week where we look at ETF indexes. We check relative strength. We check all of the major technical indicators. And then I kind of roll them up into a proprietary indicator that sort of gives you a red light, green light system for investing in the markets. We're going to go over part of that system today. This is from this weekend, and we're going to take a look at relative strength. So just a couple of terms we'll want to identify here in these charts. We're going to take a look at relative strength rank trends within certain indexes. And we'll be able to tell once something gets going to the point where it's outperforming for as long as a 3 to 6 month period. We do take that seriously as institutions and others who are able to affect prices are really kind of committing in the direction. Whenever we see an ETF that represents a market index, sector or subsector or asset class, when it's moving in a positive, bullish direction over an extended period, we as trend following traders take that seriously. But AA, we have another metric that we kind of pair with relative strength that we find to be really important, and that's Chaikin money flow, which is essentially, I mean, what would the best way would you describe that? It's kind of how stocks trade on a daily basis. Do they go in at their highs or their lows or somewhere in between, and at what volume? And so big volume and big price swings to the upside positively affect money flow. And I would argue that's probably as good a benchmark as any for institutional fund flows into a particular asset. I know you like the Force Index, but they're largely the same.
Largely
the same idea.
Yeah, it's just a measure of buying pressure.
Yep. I think we could argue that, and as you're about to see in the data, the buying pressure in, for most asset classes is sort of not there right now.
I'm interested to see your data today. I really am.
So we have a grading system. I'm going to actually explain it as we do it, but you can go to the cheat sheet blog, and the free article that I put out this weekend will describe what I'm showing you on screen in great detail. But I think the best way to see it is to experience it. So let's start at the top down. Let's take a look at the globe. This is going to be the equity markets around the globe. And W, you want to read this one from left to right, because what we're looking at is longer to shorter look back periods from 160 trading days, so market days, down to 10 trading days. And in general, when you see a gradual transition from reddish to greenish, that's bullish. It means that this is kind of like a classroom where, there's no absolute performance. It's all relative performance. Everybody's graded on a curve. That's what we're looking at here. So of the major economy index ETFs, the ones transitioning from red to green are experiencing persistent price performance that's better relative to the other ones. Now, we also have to be careful that we don't look at relative strength trends in too short a time frame. So I would argue that, and again, it all depends on your investing time frame. I happen to be an intermediate trend following investor where weeks to a few months is sort of my time horizon. I want market conditions to be in that weeks to few months time horizon supporting me. And so when we see a transition from red to green inside of 60 days, for example, Hong Kong, as you look here, is perhaps less meaningful than China, just one row down, position number 2, where China has rotated, at about the 100-day mark from being the 17th, worst performing country index ETF to first. That's a legitimate relative strength change within what we refer to as the sweet spot, or roughly speaking, a 60 to 120 trading day range, which is the equivalent of 3 to 6 calendar months. And that's just my sweet spot. Now, some might argue, Double, that you tend to be a shorter term trader. You're dealing with options and basically you're bearish and you like to capture swings to the downside.
Yeah. So it's just, like you said, it's whatever an individual prefers.
Yep. And so Double would more look at the 10 to 50 day range and look for weakness in relative strength, and then use an RSI indicator or some other oscillator to sort of time that move. But for the purposes of this podcast, this blog, we're looking for moves within the sweet spot. So that's one place your eyes should go. But the very first place your eyes should go is to a column called CMF 21 days, 21D. And you can see that anything that's green means that we're seeing a money flow score or Chaikin money flow score that would indicate positive institutional accumulation. Above 0.1, we're talking about some accumulation. Above 0.2, we're talking about serious accumulation. So when we combine those metrics and then the trend metrics, which are kind of in the middle, we get the basis for our grading system. And essentially, when we have persistent relative strength that's in the top 50% within the sweet spot, so you have to be kind of in the top half ranked as your average rank in the orange, the darker orange area. And so that coupled with a trend metric, and this is what I mean by trend metric here, where we have the longer term trend on the far right. That's the 10-week moving average above the 40-week moving average. And then we have the 10-day exponential moving average above the 40-day exponential moving average. If either of those say up, so the two trends on the right-hand side, we need one or the other to say up. We need the sweet spot relative strength to average in the top 50% or the top half. And then finally, we would need Chaikin money flow at 0.1 or better. So if those three criteria meeting, either long or intermediate trend is bullish, relative strength rank is, if you average out the 120-day to 60-day ranks, and once you average and compare all of them, if you're in the top 50% and you have money flow above 0.1, you get a grade B. So for a grade A, which are very scarce right now, we would need persistent relative strength in the top 50% between 60 and 120 days. And in addition, top 30% rank in that 10 to 50 day period. Again, it would be an average rank across those different time frames. Add to that, you'd need both the long-term and the intermediate term trend to both be bullish, and you need Chaikin money flow to be at above 0.2 or better, which is serious institutional accumulation. So I know, Double A, you've been looking at these charts for a long time. What sticks out to you automatically just based on what I just went over?
I mean, what really jumped out at me was India. it's middle of the screen here, but the money flow is very strong.
Yep, it had a soft week, or the last 10 days have been a little bit weak, last 2 weeks, 2 trading weeks, but it's otherwise been persistent, top 3. And by the way, if you look at the column that's the furthest on the left, right after the ETF description, you get average relative strength rank 3 to 6 months. So that is actually the average rank that we're using to determine those A and B grades. And to make things easier, if you don't want to have to look at the green to red transitions, just put your eyes over there. Anything that's green means it's been, in the top quintile, top half of the chart. And India has an average relative strength rank within the sweet spot of 3rd. And although it's been underperforming a little bit since then, it's still not enough to knock it down too far in the grade. And with institutional money flow, we call this a FOMO level of money flow at 0.38.
Yeah.
We won't get into the RSI indicator today. That's more of an entry timing indicator. We'll cover that on another time. I also have no idea what's happening in the UK. But they have been rotating into favor for quite some time. It's fairly persistent, not FOMO level of money flow, but a 0.16. And emerging markets as well. That kind of makes sense because commodities have been on an upswing lately. So the cost of things that fall on your feet or that heat your house or put food on the table, right? Those things are all going up. And emerging markets are a big source of exports that are commodity related. And then China.
Right.
So the market is a forward discounting mechanism. The headlines have been pretty grim about China's economy. And whenever you get mainstream press headlines about a crappy economy, that's usually when it's hit bottom, at least an intermediate bottom. And clearly investors are finding value there with some tepidly bullish money flow and a relative strength rank transition right through the sweet spot and persistent. It's been hanging in the top 3, 4, or 5 for the last 10 days.
Yeah, looks great.
But that's about it. Now your eyes can go, we make it easy for your eyes to drift to the US markets. Look at the SPY, it's not really the total market. What is it, AA? The top 500?
500, yeah. And I assume that's your benchmark here, right? As far as relative strength.
Yeah, most people are investing in US assets. Yeah. And so, it doesn't take a rocket scientist to see that from an intermediate perspective, right now is not a good time to necessarily be loading the wagon until the mule goes blind in bullish trend trades. Why is that?
Because of on the SPY?
Yep.
Yeah, because you have negative money flow for one.
Yep, first place I go to. And now we're not quite, this would be what we call neutral minus money flow. So it's, we're not at that negative 0.1 yet, but that's really arbitrary. We're close enough.
Yeah.
So stocks are under distribution and look at the relative performance compared to most of the rest of the world.
Yeah.
Average relative strength rank 4th within the sweet spot, but within that sweet spot, a huge transition at the 80-day mark from 5th to 14th. And we've been stuck there.
Yep.
So that's kind of bearish. And it means that the market safety is just, we like to have the wind at our back as an intermediate trend following trader. We like market indexes to be bullish. We like parent sectors, subsectors, and then ultimately stocks all to be outperforming, at the same time and moving in the same direction. That's where we make our greatest gains as trend followers. But of course, you have to start somewhere, right? The market does turn before then. And so then it becomes a question of, well, what metrics will support your decision to be a little bit earlier than the herd? For me, it's money flow. That can cause me to move a little bit earlier.
Yeah, I tend to agree.
All right. So when we do a top-down analysis, global stocks are an important barometer, but it's certainly not the only asset class here. So we have this section we usually do about once a week called Global Macro. And this would be kind of big, broad indexes that represent different asset classes here. So we don't go really narrow or deep into any one asset classes. So these are kind of broad indexes. And so everything from the euro and the dollar and the yen to government bonds, international government bonds, aggregate bonds in the US market, to various areas of equity like Latin America or the Eurozone or the developed countries in the Europe, Far East, and Australia, ex-US, dividend growth, global dividend growth. And so it's like that. And so you're the big macro thing, or the macro guy. I'd say the one thing that stands out to me is there's just not that much with any kind of money flow going on right now.
Yeah, not really.
It's not like you can be a 60-40 stock bond investor expecting your bond portfolio, not with interest rates this high, to appreciate. So where do you hide? Well, it looks like a lot of investors are hiding in the dollar.
That's right. That's right. But the dollar also backed off a bit this week as well.
It did. You'll see that we had a poor relative strength week. And I guess this is because, why don't you explain, while the Fed didn't raise interest rates or didn't take too many rate cuts off the table, it did something else that made it a little bit more dovish.
Yeah, well, the chairman struck a very dovish tone and pushed back against the idea of rate hikes. He pushed back very hard, but I think what you're getting at is they reduced the rate of their quantitative tightening, or the process at which they've attempted to shrink their balance sheet. They cut that in beginning in June, I believe. They're reducing the amount of U.S. Treasuries that they allow to roll off by $35 billion a month, which means they can then reinvest that $35 billion back into Treasuries. So basically, in my view, it's a move to support the Treasury market and new debt issuance.
Yep, it's basically to lower interest rates in sort of a stealthy way, because
Mike, actually,
increase interest rates. Yeah.
No, I'd say it a different way. I'd say it's an effort to stabilize interest rates, right?
Yeah, that's fair.
To kind of keep them from having swings based on Treasury issuance.
They're not flooding the market with as many yield-oriented securities, which would, when you're having a bond fire sale, you are in effect lowering the cost of bonds
and pushing the yield. The inverse was the yield higher, right?
Higher. That's right.
Yeah.
Yep. And so they've started to withdraw, or I should say their dump rate is lower by about 30 to 35 billion, as you said. I think the number was from 90-ish to 60-ish.
Yeah. The difference is 35 billion that they're now going to have to reinvest monthly.
Now, the one thing that we've been quite kind of sounding the alarm on is the other ETF to look here is the one. There's actually two of them that are rock bottom right now, but if you look, they're 8th and 1st on a 3 to 6 month relative strength basis. And I think we saw this starting in January, early February, where we saw DBC and DBA. That's the broad-based commodity index and agricultural commodity index. We started to see those catch a bid, a good 3 months ago. And they had, and the money flow had been quite persistent up until recently. And I guess this move here is the market, the economy is starting to get a little soft. And I would say the economic data, despite the fact that inflation has been persistent, the economic data is getting a little worse. I know here in Austin, we're having a housing crash right now. My house, not that I care that much because I'm living in it, but it's lost $100,000 worth of value since the beginning of the year.
Wow, I didn't realize it was quite that severe.
Yeah, Austin, I think, is a leading market because it got so overbuilt and so expensive so fast. But do you think this 20-day relative strength move out of commodities, is that being driven by economic pressure? Or do you think it's the fact that Israel and Hamas and Iran are at least not at each other's throat to the point where that regional war is going to expand anymore, or it looks less likely to do that now? You think that was a geopolitical premium, or do you think this is the first signs that maybe the Fed is rolling over the economy with persistently high interest rates?
I'm a big believer that it's never just one thing, right?
Yeah.
But I do believe both of those things are true. But I also really do believe that the geopolitical element that you mentioned is playing probably a pretty big role here.
Now, I think it's interesting to note that when you look at the Japanese yen, FXY, and I guess the other one would be FXE, the euro. Look at the money flow on those two ETFs.
Yeah, so I don't know. I haven't been following the story with the euro. The yen makes sense to me, just because it's been so battered the last
Yep.
few months.
Yep.
I mean, to levels that it hasn't seen in decades. So just
Yeah, American tourists over in Japan are getting a hell of a deal right now.
yeah. So any contrarian will look at that and go, "I'm going to take a shot," and it looks like a lot did.
Yep. So one of the ideas here is that the dollar is the reserve currency, and the dollar is expensive right now at a 5% yield on a 10-year Treasury. I'm sorry, it's the Treasury isn't 5%, but the bank interest rate on the people investing in short-term
Like a money
government
market.
securities are getting paid 5%. So the
Yeah.
dollar's expensive right now, and the rest of the world's economy is not as robust as the United States.
That's true. Yeah.
And so there's definitely a panic for dollars out there. Now the dollar, again, this past week with the Feds, I think this speaks to stabilizing global currencies more than anything else, right? The dollar is getting really expensive, and I think that quantitative tightening news or the loosening of the tightening probably helped the currency markets a little bit.
Yeah, I'll just real quickly, if I could say something real fast about the currency, like that, they have to be careful not to create a currency crisis by, because if other central banks start cutting and we, stand pat, I mean, that's going to push the value of the dollar up and the value, relative to other currencies down, and that could create a real global problem if it became severe enough.
And Gazelle would have to get paid in euros again.
Imagine the horror.
All right, so the commodities. And I think one of the more interesting stories is gold had that big breakout, and gold and silver, precious metals in general, with the exception of maybe platinum, has definitely weakened recently. So we had that big breakout move. You think that's just a retracement before we get going again on precious metals? But there's enough evidence here that suggests to me that the normal stuff that rises when market is worried about inflation, that the inflation data has been hot lately, but it looks like, again, early indications are that the inflation might be about to start slowing down, and the market is discounting things like gold, silver, maybe even oil. Again, I realize the geopolitical premium was, a big driving force on oil, but in general, with the exception of certain soft commodities, we've seen the commodity premium come out recently.
Yeah, a little bit. Gold, I don't know. I mean, there was a lot of buying pressure in gold. I don't know where it is at the present moment, but the first quarter, there was a lot of buying pressure from other central banks. They've been accumulating gold at a pace not seen in a very long time. So
China announced over the weekend that it was stopping buying any U.S. treasuries and was going to convert to gold purchases.
Yeah, and a lot of countries are following suit. So I'm not sure what to make of gold at this point. I mean, so far, I mean, it's still in an uptrend, right? So technically, nothing is broken.
Right. Well, here's the thing: you've got to look at that 120 to 60-day sweet spot before you start trying to game the system. So right now, gold, overall, the number 2 ranked asset class in the commodity complex. And that's over the average 120 to 60-day look back period. And you can see very little fluctuation there. Where you get some fluctuation is in that 20 to 10-day range. And typically when we see that, what we're seeing is a simple technical retracement and nothing more. And that the only thing I would say is the money flow did come out of it. Now only to neutral, right? Money flow is actually 1/10 of a point or 100th of a point above zero. So it's technically still on the positive side, and that's not a bad thing for an intermediate pullback.
Right.
So the story is to be continued here. I think wheat and corn, those things look like they're on the verge of rotating into favor. Money flow is a little better this week. We're not quite at the sweet spot, but let's face it, we're predicting a really hot summer. The globe gets bigger every year, and the food supply is an issue.
It is.
All right, so that's our look at commodities. Now let's focus on where most of our audience is concerned about. What jumps out at you here?
Let me take a look here.
XLU is utilities.
XLU.
It's 5th ranked overall in the 3 to 6 month average on the far left. But look at that transition. Remember, there's 11 total U.S. sectors, plus the S&P 500, which we use as a means of comparison here.
And I mean, so your point about XLU is a good one, but also something that stands out to me is that money's coming out of tech, which has led the U.S. markets for I don't know how long now.
It has. So utilities, this is a classic cheat sheets, intermediate time frame rotation here, where within the sweet spot, we've gone from 7th and 9th to 5th, 8th, 2nd, 1st, and then we've held. So that's a grade A right there, right? We're in the top 50% within the sweet spot. And then we're also in the top 30% within that shorter term time frame, meaning the momentum is either accelerated or sustained. We have both the long-term and intermediate term trends. That is the center column and the far right column, the daily and the weeklies, the moving averages have crossed bullishly. And we have what I'll call a FOMO level of institutional money flow. Money is pouring into utilities. And usually we see that as a defensive move in the market, also usually as a yield replacement. So clearly there is some concern, I guess, that these high-flying short-term treasury yields aren't going to last much longer.
Yeah, that's what I was going to point out, is that if yields are rising and utilities are rising, one of them is lying.
Yep. So the other thing that we like to look at is the XLY, which is consumer discretionary. These are things that most of us can live without, especially if we don't have any more credit card bandwidth and we're not trying to keep up with the Joneses. You know, we'll cut discretionary expenses, but we hold on to what we call staples or consumer staples. So XLP, defensive, XLY, much more extra dollar purchases that people do without in harder times. We've seen the XLY weak for a while now. Now we did have a couple of days or a couple of weeks of better relative strength recently, not supported by money flow. That feels much more like a retracement to me. And the XLP rotation, that does seem, although it's early, right? But we are starting to see some rotation within the sweet spot from, the beginning of the sweet spot in the 10th and 11th position, coming out of the sweet spot, in 6th, and kind of we've gone up from there with 0.16 money flow. Trends are good. That's another defensive sector.
Mm-hmm. It is.
And with Tech Week, as you mentioned, although a little bit of a rebound the last couple of trading days, really. Financials is also one I'm paying attention to because we keep getting rumors about bank blowups. And so we are definitely seeing money coming out of XLF, and the sweet spot rotation hasn't broken quite yet, but it looks like it's about to. And then energy companies, with the price of oil retracing, that brief intermediate period of bullishness with money flow settling now to neutral, that seems to be that we're going to have a little period of consolidation in energy for a while.
Man, the wind came out of that sail real quick, didn't it?
Really fast. Yeah. And that seems to be tied to Israel and Iran not going to war.
Yeah.
Okay. So now we're down to the subsectors or industry groups. This is where narrower slivers of the economy can outperform in more bearish market conditions. I don't think either one of us has any of the data so far convinced you that now is a really good time to be hand over fist buying into the U.S. market.
No, not so far.
Definitely not. Now, there are a few places that are interesting, but you got to watch out for getting faked out by headlines. Like there's been a lot of headlines about some semiconductor strength in the last week or so. But when you look back on it, there's just, look at that. We're still at a very significant distribution level and not much happening in the sweet spot yet. Maybe we've bottomed here, but until we start seeing a few top 3 performances out of XST, I'm looking at the 11th rank and the money flow at a distribution level, and I'm talked out of it.
Yeah.
Anything that you find interesting? I think XAR is interesting. The money flow is not there, but the rotation is definitely there. And the U.S. is going to spend some some bucks on its defense industry. And did you see airlines pop this week? United Airlines had a hell of a week.
No, I did not see. I wasn't paying attention to that this week. No.
Yeah. So commercial air travel, defense contractors, big, heavy industrial companies that are related to transportation and defense seem to be doing a little better. And I don't mean like consumer transportation. That would be more XTN. There's nothing happening there. But I'm talking about the stuff used to transport heavy equipment.
Yeah.
That seems to be moving. So XAR is interesting to me. Money flow, not quite there, but we did look at a industrial ETF that I'm going to actually share at the end of today's podcast. I should have mentioned this. We got a few. I've got one ETF pick to share, and I also have 3 trade grades to give the cheat sheets and analysis team. Okay, me.
The one thing I'll mention here, we've mentioned this before, but it's persistent, is that XSW, which is software and services, is still bucking the tech trend. So as money flow and tech itself struggles, XSW, which is a subsector, continues to, on a relative basis, do better anyway.
Innovative tech as well, and I'm not quite sure. These are the S&P 500 ETFs. So meaning the S&P company, this is how they subdivide the economy. Some of you have written to me saying, why the hell are you using like XES instead of the OIH? And yes, it's true. There's some other ETFs that are more liquid out there for trading purposes. So you really use this for trading purposes. This is more to analyze the market. And so think of these as having some discrete fences between them, so you're not looking at ETFs that overlap a lot. So this is subdividing the economy into about 22 industry groups, and so that's why we prefer to use this. I'll give credit to Mark Chaikin and his app for inspiring me to do this, subdividing this way. But that said, I don't know what the difference is other than to look at the holdings between innovative tech and software and services.
Yeah, I don't know either,
because a lot of them overlap. I guess one has some chip technology, and it isn't just strictly hardware. It isn't strictly software. There's hardware involved, but a lot of these industries, they're blending the two together.
Right, and let's be honest, they could hold the exact same names, and then it comes down to weighting, right?
Yep. So XITK and to a less extent, software XSW, both look decent from a money flow standpoint. As does capital markets, which might seem counterintuitive, but other than a kind of a weaker week this week, I guess institutions do a lot of trading whenever the market transitions. So that's probably what's driving that.
Yeah, it makes sense.
Yep. Commissions on calls and puts and other sorts of instruments that are designed to help institutions hedge against markets in transition.
Got it.
We also are reaching the golden tsunami. Or the silver tsunami, I think it's called. Do you realize that there's more people turning 65 this year in America than ever in history? And that means an awful lot of folks going from net savers to net wealth liquidators, which I would argue is another headwind on stocks, that there's going to be more folks cashing out than buying in moving forward.
Yeah. No, that makes sense. I've definitely read about that.
Now, another sector that we've seen not necessarily have very good price performance, but we'll also argue that money flow usually happens before prices start to move. Money flow is sort of your earliest indicator. We're seeing healthcare services catch a bid. Again, another defensive area of the market. You have to pay for your doctor's appointment, God forbid, your cancer treatments. And so that's sort of an economy-proof sub-industry group in the market. We're just not, so we're seeing institutions laying their bets, but we're not yet seeing that translate into price appreciation.
And to back that story up, healthcare is one of the industries leading in job creation.
Yep. So energy, XES, XOP, the metals and mining, copper, and other industrial metals, all at the bottom right now because the last 20 days have not been kind. But I would argue that we're still seeing an intermediate trend, 10 over the 40 moving average for all of these sectors. The relative strength performance in the sweet spot still peaks at the 60-day level. in the top 5. And so I'm not sure yet, because again, I kind of counteract my own earlier hypothesis, but this is not evidence that commodity inflation is going away and that energy inflation is going away yet.
Got it.
All right. So this again is how to look at the relative strength charts. Moves like you see in the bottom of the screen or what to pay attention to, and then look toward money flow next. Be wary of earlier moves, although this one would represent probably kind of the earliest relative strength transition, where you're going from 28 days in the third row from the top. 28 days, 25, 15, 12, 7. That's the earliest kind of relative strength change that I look for. And a much more common and comfortable one is a relative strength transition that takes place in that, about that 4.5 month mark. You're just much safer making multiple investments in the market when we are more bullish. And right now the S&P is going in the opposite direction. All right, a few trade grades.
Okay.
All right, so we'll start by, I guess, going back in time, and we'll look at 3. And this is actually the results. So let's start here. So this was an article I published in late March, about a month and a week ago, where we looked at dry shipping index was looking pretty good, and one other sector was looking pretty good. So Gogol, not to be confused with Google, Golden Oceanic Group Limited was in a nice uptrend, and we were taking, I think, a bounce entry at the time. When we do the premium stock recommendations, or picks, I should say, there's nothing that's a recommendation because you need to do your own homework. We gave you, a summary of their business model, the recent financial performance, some of the strategic initiatives that were taking shape that would make us more bullish. But the bottom line here is we were looking for an uptrend bounce and for the trend to continue. So that's GOGL. That's the first one we'll give ourselves a trade grade on.
Okay.
Second one is again in the dry shipping industry. Again, very similar looking chart. One thing, I made a typo here. This is GNK, not GNL. I hope I didn't steer anybody incorrect. But again, nice trend up. We were looking for post-consolidation run to higher highs. And again, the same thing, overview, business model, financial performance, and the kinds of moves that the company has made or will be making that would justify higher prices. And then we kind of looked at the in common comparisons between GNK, that's the correct ticker, and GOGL. And then finally, HIPO, double, we talked a lot about this. This is probably a market technician's worst nightmare, right? You probably would avoid anticipating a breakout.
Yeah.
Yep. And so this had a huge run up, a little bit of a pullback over approximately a 5-month period. And we saw the money flow starting to build in this thing and the relative strength within the industry group, but it was pinned against resistance, anticipating a breakout. Again, we liked the story behind this one. And so those were the 3 bets we placed.
Okay.
So let's see how we did. All right, let's start with GNK. Again, sorry about the typo. I recycled my own typo. No, actually, let's start with Hippo. So here's your anticipate the breakout. So do you think we broke out?
I'm going to guess, since we're talking about it, yes.
Yeah, this is a love-hate story. Now, as a trend follower, you have to have a stop loss. So here's the story. Here's that breakout point. Here's the breakout. And we hit a peak of $25 about, this is weekly charts I'm looking at now, because we had a 4-week consolidation back to the breakout point. And that the stock price was at 22.5 up through Thursday of last week. And then they missed by a penny on earnings, and the market just slammed them on Friday.
Back to the same point.
Yeah. Now, of course, I have a rule where I never trade earnings, and because there's just too much risk to the downside versus what you could make to the upside. So for those that got out in advance of earnings, you made a nice little, $2.50 profit. So over 10% return.
Yeah.
If you got out at the peak, very unlikely. you made over a 30% return. So we got it right. It's just a question of your trading skills and risk management are as important. And that's why in the blog, I put a reminder of what our policy is when we're in a bearish kind of market circumstance. We don't like anything fall much below its 21-day moving average. We use a volatility-based stop loss called a Keltner channel. To make a long story short, it's basically to put the trading range of the stock just below the moving average and get out. Now, when things are green across the board, we like to let stocks run. And so 40-day moving average is generally my exit point because I'm looking to gain, 2/3 of the move. We'll never catch the bottom. We'll never get out at the top. But by giving your stock more wiggle room with a 40-day moving average plus a little extra room for a stop loss, you generally will catch more of the trend, except when the market starts to turn, in which case I always tighten things up to the 21-day exponential moving average. And I got out before earnings, made a couple of bucks.
Got it. Okay.
Okay. So that's GNK. Next, or this is GNK now. Here's the setup. And then here's the result. So it's a little off-putting to see, but here we are in late March. So after this bounce, we consolidated sideways for a couple of weeks, and then we ran up. What do you see coming up, AA?
Earnings.
Earnings. So let's not look a gift horse in the mouth. We have a 10, 11% return. Let's get out.
Yep.
Okay. Finally, Gogol, GOGL, same thing. Here's your nice little uptrend. Here's the pullback to the diagonal support level. We anticipated a bounce, and this is, more of the dry ship index. And we kind of got that, but again, another sideways consolidation. So here again, here's late March. Here's that bounce. Here's the pullback. Here's the bounce. Slight drift higher, and then boom, we made a nice move here to the top. But again, earnings still a couple of weeks away. I'm not going to be greedy, AA. I think the commodities are starting to roll over, and dry ships should come along for the ride. So I'm going to take profits on Monday.
Got it. Makes sense. Risk management.
Yep, that's it. So we also have premium stock picks, but we save those for our paid subscribers, and you'll find those in today, Sunday, Happy Cinco de Mayo, by the way.
Yeah.
Sunday, May 5th, premium stock picks for paid subscribers. If you're not a paid subscriber, you can go to stockcheatsheets.substack.com and sign up for a free 7-day trial. And we'll show you what we're considering strongly for purchase beginning tomorrow. Again, depending upon market conditions. AA, anyone reaches you wants to reach you about mortgages or wants to subscribe to your Substack, where do they go?
It's just find me on Substack since we're here already. It's Macro to Mortgage.
Great.
Yep.
And then what about your Colorado-based mortgage company?
Hey, if you're in Colorado and you want to talk about a mortgage, home financing, it is localadvantagemortgage.com.
And I am Mike O'Connor, and this is stockcheatsheets.com, and that's exactly where you can go to subscribe, or you can go directly to Substack and then look up Stock Cheat Sheets. Again, it's most of the blogs are free. Just the premium stock picking service, because that takes me a lot more time, is where I ask for the $50 a year, $5 a month. All right, shill is over. Until next week, thank you, AA, for your time again this week.
Thanks for inviting me, Mike. Always fun.
Great. We'll see you again.
Bye.